Welcome to the Market Mosaic, where every week we are looking at the stock market's next move by covering macro data, technical indicators, and market internals, things like breadth and sentiment. So we're looking at the intersection of all these things, try to figure out where the market could be heading over the near and intermediate term here. And look, we have a very important week upon us. It looks like the trade war is getting ready to enter a new phase. President Trump releasing public letters last week and over the weekend announcing a new round of tariffs, most of these going into effect on August 1st. That includes new rates of 30% against the European Union and Mexico, 35% against Canada. And look, the effective tariff rate already currently, so this is before these go into effect, currently stands at 18%. That is the highest level since 1934. And again, with these most recent announcements, unless we get another delay or Trump changes his mind, that effective rate looks to go higher still. And here's what's interesting. As more tariff headlines hit, we are seeing major moves last week in several areas that I will call scarcity assets. So in metals and cryptocurrencies. Really, it started with a surge in copper prices. The domestic benchmark for copper jumped over $5 per pound. That took it to new record highs. We know Trump announced the intention of putting tariffs on copper imports last week. But look, Bitcoin and silver following along. The world's largest crypto by market value rose to a fresh record high as I'm recording this of $119,000 on Bitcoin. Silver rose to about $38 per ounce. That is the highest level since 2011. Bullish chart patterns flag those breakouts. We are seeing bullish continuation patterns in both Bitcoin and silver. And look, the timing of these breakouts is notable because the latest round of consumer and producer price inflation reports are due this week. Now, what this table does, this looks at estimates from the Cleveland Fed. The Cleveland's Fed district has a inflation nowcast. You might be familiar with the GDP Now report that comes from the Atlanta Fed. Well, the Cleveland Fed, they maintain this inflation nowcast report. And this shows that headline inflation, based on their estimate for June, headline CPI is expected to go to 2.64% in June. Core CPI, excluding food and energy, is expected to go to 2.95%. That is an acceleration from last month's level. Last month, you had 2.4% on headline and 2.8% on core. So are we maybe starting to see inflation inflect higher? That's interesting to think about because then they have July estimates out as well. In July, you can see another slight tick up to 2.7 and 3.05%. So we're starting to see those figures inch higher. We've had this trend of disinflation since mid-2022. Is that trend coming to an end? Well, there's something else we want to look at with all this. So a lot of the inflation fears are coming from these tariff headlines. That's what's reigniting inflation fears. But there's something else we need to keep an eye on. There are price pressures building just beyond what you're seeing from the impact of tariffs, and that is with food prices. Food prices could become a catalyst for higher inflation as well. And so what this chart here shows is that it shows the annual gain in fertilizer prices. So that is the gold line on here. Fertilizer prices, the percent change year over year, and this is pushed forward 6 months. So you can see moving this forward 6 months, that shows this can be a leading indicator to U.S. food CPI's year-over-year change. So you can see when you move this forward 6 months, it lines up pretty well with some key inflection points looking back with food CPI. So because that tends to change, and now look at where we're going. We bottomed out in late 2024. Again, this gold line on here. And we're now back at the highest levels, starting to inflect higher, which this tends to lead the way in food prices. And you've already seen food prices starting to turn higher here as well. So keep an eye on food inflation as well and what that could mean for the broader inflation picture as we look into the second half of 2025. Now here's something else that's sending off an inflation warning, and that is with copper prices. So we've covered this before. We talked about how copper has one of the highest correlations of any assets to long-term inflation expectations. And so look, a planned 50% tariff on copper prices, that's what sent the domestic copper benchmark surging to new highs. Again, it's also supposed to start on August 1st, and it's meant to encourage more domestic production. But look, U.S. imports nearly half of the copper it uses. So there's not a quick fix to all of a sudden bringing on more copper supply, whether that's mining capacity, but then from the mines, you got to refine it. And we just do not have that capacity. But look, the tariff announcement, that might have been the catalyst. Copper prices back here as it's breaking out, it had a 13% gain in a single session. That is the largest one-day rate of change ever. And again, the tariffs might have been the catalyst, but look, bullish energy has been building in copper prices. I've shown this chart frequently over the past several months, how copper is making something called an ascending triangle pattern. Ascending triangle, you have a series of higher lows with a flat top, so you hit a common resistance level. That resistance level was happening around the prior record highs for copper, around $5 per pound. Eventually, as you get these higher lows, that shows buyers are stepping in more quickly, and eventually that leads to a breakout. That's exactly what we saw with copper. So again, tariffs might have been the catalyst to push it out of this, but this was a bullish setup that's been developing really since late 2023 or early 2024. All right, so we're seeing a number of areas that I, again, call them scarce assets breaking out. Silver has been no exception, and this move in silver could just be getting started. Look, after breaking out over $35 an ounce, silver ran up to around the $37 area, started to form a bullish pennant continuation pattern. It's where price just starts to coil really tight. And silver's move last week out of that pattern put it at the highest level since 2011. But look, the upside could just be getting started. We could still be in the early stages based on where the ratio of gold to silver prices currently resides. So that's what this chart here shows. This shows the ratio gold prices relative to silver. So when this red line is rising, that means gold prices are outperforming silver. When it's falling, vice versa, that means silver prices are outperforming gold. Gold, this goes back to 1975, so you can see the longer term trend in this chart and where kind of the extremes reside on the highs and the lows. Well, ever since gold started breaking out to new highs in late 2023 and early 2024, silver's gained as well, but you can see gold has outpaced silver. So you've got this rising red line here. But look at where this red line took us to. We're at some of the highest levels that you've ever seen this gold to silver ratio. And we're starting to see this mean revert back lower the other way. So the valuation ratio got stretched to the upside. So it becomes favorable for silver, and now we're seeing silver's momentum really pick up as indicated by the pullback in this chart. But right as silver's starting to take out some key levels, silver's not even at new all-time highs. And so I would not be surprised with where this ratio chart is at, given silver's recent breakout, if we at least test the prior highs that was somewhere around $48 to $50 per ounce, maybe even seeing a breakout from there. All right, I want to pivot really quick and talk about this rally to new highs on the S&P 500. The S&P has completely recovered from the sell-off into early April on an intraday basis. That took it down more than 20%. So we're in a bear market, and we quickly rallied back up toward the prior highs. And now, since the end of June, start of July, we've been setting new record highs on the index. And look, over the long term, stock prices follow earnings. And so I believe this chart offers a very, very key and important explanation for the massive reversal that we've seen in the S&P 500. So what I would say this chart shows is it shows optimism around earnings. This chart shows a Citigroup earnings revision index. I included this blue line on here is just for the US, so I took off Europe and Japan so you can see this more clearly. What this does, it looks at the proportion of companies seeing upward revisions to earnings relative to downward revisions. At the end of May, revisions for US companies jumped back into positive territory. So again, if you go back and you look at this, you'll actually see that for pretty much all of 2025, this blue line has been below this zero line. So we've had negative earnings revisions that really picked up as we saw the market sell off into the April lows. We've had this massive reversal higher. And here again, at the end of May, you had this earnings revision index go positive for the first time this year. Again, for the first time this year, and then went on to rise towards some of the highest levels we've seen since the start of 2022. And so I think this massive reversal in earnings revisions for domestic companies has been a major, major catalyst in driving the market out back toward the prior highs and now out to new record highs. All right, so Fed's been in the headlines a lot lately. President Trump continuously demanding that the Fed needs to cut rates, but here's what's interesting about that. Despite the relatively high level of Fed funds, financial conditions overall are running near their loosest level since this bull market started in late 2022. And so that's what this chart shows. This shows a measure of financial conditions. This comes from the Fed's Chicago district, and this is constructed so that a reading below zero, so here's a zero line, if it's below zero, so you want to pay attention to this black line here, below zero means conditions are looser than average. Zero is the average. And this black line, this is really just the cumulative reflection of indicators spanning credit, leverage, there's equity factors, there's money market instruments. So it goes well beyond looking at the cost and availability of credit, beyond just looking at the Fed funds rate. And when you look at cumulative, those cumulative weights of all those factors, conditions, are running the lowest levels we've seen since the start of 2022. So overall, despite the high level of Fed funds, and here's why this is important, is because loose financial conditions like this are highly correlated to economic growth. So this is another tailwind that you're seeing for the economy. If it's a tailwind for the economy, it means it's a tailwind for the stock market here as well. And if the Fed is looking at this, this is another reason why they might not feel too compelled to have to cut rates significantly here. All right, so let's also look at some other things to get ready for the week ahead. We know inflation on the economic side is going to be in the headlines this week with CPI. We also get a look at the producer price index, but here's something else you need to have in mind. It is the start of earnings season. So June 30th, we wrapped up second quarter earnings season, second quarter reporting period, and so earnings season really gets kicked off this week. And some of the early reporters that you really want to pay attention to are some of the major banks. So you have JP Morgan Chase, you have Citigroup, Wells Fargo. We'll also get some other asset managers like BlackRock. What you want to watch for with these banks here are underlying credit trends. If they're making any adjustments to provisions for loan losses, if they see tough times ahead, I'm going to look at underlying lending and credit trends. It'll also be interesting to see if these major banks start to say anything about the recent review that the Fed is doing on reserve requirements. So some stricter reserve requirements that went into effect after the financial crisis. There's talks of winding those back, and by doing so, that should free up more capital for lending. So again, that could be another catalyst that keeps financial conditions loose here if it frees up a lot of capital for lending. One other company I would keep an eye on this week is with Taiwan Semiconductor, TSMC. They are the largest chip foundry in the world. They are a foundry. They manufacture chips for companies that design semiconductors. Their most notable customer is NVIDIA. So this will be an early look during the reporting season of how trends within semiconductors and specifically AI with artificial intelligence is progressing. We'll get a look at how TSMC's various end markets are performing along with sales and earnings. So that is a key one to keep an eye on here this week as well. All right, one trade idea I want to keep on for the week ahead. We reviewed this one before, and I want to come back to it because it continues to set up, and that is with Trane Technologies. Now, they operate in the HVAC space, so heating and cooling systems for residential and commercial customers, which may not sound like a very exciting industry till you consider the fact that their equipment and equipment of other HVAC providers is instrumental in the data center build out. So data center demand from AI applications, while you need cooling equipment for those data centers. And that's been a huge catalyst for companies like Trane Technologies, ticker TT. And here's a setup we're watching for here. So the stock originally peaked out back around this 420-ish level back at the start of the year, or the end of December actually. Had a pullback into the April lows when the market was selling off, rallied back to new highs, and look, so this line shows you where that breakout to new highs occurred. Broke out to new highs, but it's doing something you see often, which is it's coming back to test that level. So what was resistance now becomes support at this 420 level, and in doing so, the stock is making something called a base on a base pattern. This is progressing along really nicely. When you see a base on base pattern set up, ideally you see a really tight trading range like we've had here, in that it's creating new resistance around this 440-ish area. And so that's the next level we want to keep an eye on here. We want to watch for a breakout to new highs over the 440 level. As we've seen this nice consolidation take shape over the last couple months, that's reset the MACD above the zero line. So I would look at that as a positive momentum reset. We'll pay attention to the relative strength line. So this plots the ratio of Trane stock price to the S&P 500. A rising line means train's momentum is outperforming, so we want to see that momentum continue. And if we do get a breakout, we want to see a big purple bar down here. This is looking at the standard deviation of volume relative to its average. And so if we can see a much larger, we want to see much larger than average volume on a breakout, which would produce a nice big purple bar on here, ideally looking for a 2 standard deviation event on volume if we can get a breakout and train above those levels. All right, that's all for this week. Good luck in the week ahead.